We're seeing a lot of people very focused on operations. So once again, just sitting down and going over budgets, and not to just do budgets to do budgets, right? But really come up with numbers and projections that you feel are achievable, and hold your team accountable to. If you're the operator, holding your asset managers and your management team accountable.
Should you invest in commercial real estate today? And if so, what should you be focused on? This is your daily real estate syndication show, and our guest today, Doug Banerjee, is going to focus on just that. He's a senior managing director at Graysteel Multifamily Investment Sales Brokerage in Dallas. I think he's a pretty big radius there that he and his team covers, but he's been in the industry since 2011. He's Midwest focused with Arkansas, Oklahoma, Texas, a pretty big radius. If you're in the area, I would recommend you reach out to him. I'm telling you, heard him on the Real Estate Syndication Show. But today we are going to dive into commercial real estate. Why today? And you're going to hear an expert opinion from somebody who's focused and done lots of transactions in a very large radius, but specifically focused in on multifamily. But I think all of these things that Doug's going to mention today are going to apply to you, almost any asset class that you are in. We're going to talk a little bit about, high level, about being a broker, what that is, but then we are going to dive into reasons to invest in commercial real estate today and what you need to be focused on. Doug, welcome to the show. I'm honored to have you on, and it really bring your expertise to the listeners and to myself. But let's focus on the listeners, right? And so I'm honored to have you on, like I said, and I feel like it's very timely as well to bring your expertise. And we're going to, just so the listeners know, we're going to do a couple shows with Doug. So we're going to dive in on a few different things and allow him to educate us in a few areas that are ultra important in commercial real estate, almost in any asset class, right? So Doug, welcome to the show. Give the listeners, though, a little bit about who you are. Let's talk about how you got to where you're at to some extent, and then let's dive in on a few specific things.
Okay. Well, I appreciate you having me. I'm excited to have conversation here. And so a little bit about who I am. I'll give you the very abbreviated version. Senior Managing Director at Graysteel. I founded the Texas office back in January 2014, with just myself and my business partner at the time. So 2 producers and a few support staff. And now we've got roughly a dozen investment sales producers and a dozen capital markets producers, and another 6 or 7 support staff in Dallas, plus a separate office in Austin, San Antonio that my colleague counterpart, J.R. Ellis, runs down there with half a dozen folks. So I run the investment sales team and wear a few different hats. So we've got a 10-person team on the market rate side of things that covers what I call a 5-hour radius from DFW. So we're doing deals in Oklahoma, Arkansas, Louisiana, East Texas, West Texas, of course, DFW. And then one individual on our team, Jack Stone, also covers El Paso in addition to that 5-hour radius. And I also help out with our national affordable housing team, our Texas land sales team as well.
Nice. Wow. So founded in 2014, but sounds like you all have grown a lot.
Quite a bit.
Very fast, and obviously a great place to have that kind of business, I think, as well. And so congratulations to you, first off. But let's even break that down a little bit before we dive in further. But commercial real estate broker, we hear that terminology in our industry all the time. Give us a little more detail about what you do, right? What does a commercial real estate broker do? Give us some of the day in, day out types of things, especially as an operator, or maybe some newer operators that are listening. What do they need to know about what you do and why?
Yeah, so I would break a broker down into kind of 2 separate paths. You've got a generalist and a specialist. So typically in smaller markets, it's hard to be a specialist, meaning a specialist focuses on one product type, whereas a generalist will do all of commercial real estate. They might do just sales of any product type, or leasing, or both. And the product types could be multifamily, retail, office, industrial, self-storage, land that's zoned for commercial development. And there's a few others as well. But I'm a specialist. So on the brokerage side, I focus solely on multifamily investment sales. And as I kind of shared, we have a 10-person team. So we're geographically focused. Every person on our team has a geographic focus in addition to being a multifamily specialist. So if you came to me and said, hey, Doug, I've got this great shopping center and I'd love for you to value it for me and sell it for me, I'd say, Whitney, I appreciate it, but I'm going to introduce you to somebody else who specializes in that. That's not my forte. That's not what I do. So I'm not going to be the best execution for you. But if you have a multifamily deal that falls within the geography that my team or another team within Graysteel is covering, absolutely, we can help you. So we are out there touching base with all the owners in the geography. So for myself, I'm very much have been for 11 plus years, Dallas County focused. So most of the owners in Dallas County, so the eastern portion of the DFW Metroplex, at some point or another, I've probably, touched with a phone call or many emails, right? Because we're a marketing machine at the end of the day, active on social media as well. But I want to get in front of the owners, understand who they are, why they purchased their assets, what their business plan was when they bought it, and how I can help them achieve their goals, right? I want to be an advisor for them and a partner because I earn my money on the back end. So we have the same license as somebody selling a house. We just have a real estate license, but we're referred to as brokers as opposed to agents or a realtor. A realtor, a real estate agent is typically what you would refer to somebody selling your home, which I have a real estate agent who works at Compass, and I hire him to sell my house. Even though I'm licensed to do it, that's not where my expertise is. So I hire the professional to do that when the time comes. But if I own or I'm representing somebody with a multifamily property, of course, that's where we come in and we charge a commission on the back end. But we're helping advise for months or years up until that sale. And that's kind of where we build the relationship and the trust to where, hopefully when the time comes that they're going to sell that asset, they hire our team.
Right. No, that makes complete sense. I appreciate you breaking it down like that for the listener to know as well, a generalist versus specialist. And I think it goes without saying as far as why we would want a specialist, right? In so many ways we could talk about why that's so helpful. But when would we want a generalist?
I think generalist, I've got a very good friend in Morgantown, West Virginia, and he, of course, would refer to himself as a generalist, but he's a specialist in that market. So I think if you're in a smaller market, it makes sense to work with a generalist because they're going to know the ins and outs of what's going on, whereas someone like myself might not. But in my mind, it really depends on the product type because a multifamily specialist, if it's a multifamily deal, was probably going to be better served because we have a lot of access to tools, CoStar, Yardi Matrix, Trep, Reonomy, just to name a few, where we can kind of get that market data, even if we're not physically located there. I think leasing, you can work with a generalist as well. So I think really learning an area.
A ton of sense. And I think it'd be very market specific, right? Like your 5-hour radius that you're talking about, there's so much commercial real estate, right, being traded. I could see that being no doubt a place to, have that specialist. But I thought it was a great example. Morgantown, West Virginia, there's not as much multifamily trading as there is in Dallas, Fort Worth, right? Sure. And so I can see even why that broker would need to be a generalist to some degree, right? To even make a living, maybe to have the transaction volume.
100%.
But even be able to help more clients in a smaller, right? Versus in your market, well, there's multifamily clients just coming out of the trees.
Yeah.
Let's talk a little bit about, and I'd love your take on like reasons to invest in commercial real estate today. And while there are trillions of dollars, right, we all know sitting on the sidelines today, waiting, right, for something to invest, right? I would just love your thoughts on reasons to invest in commercial real estate, maybe generally for some of our newer listeners, but even what you're seeing in today's market and why still today is a good day, if you believe so, to invest in commercial real estate.
Yeah, absolutely. So there's a number of reasons to invest, but there's a lot of tax advantages, kind of number one. So obviously you can go out today with the treasuries and get anywhere from a 3.5% to 4.5% risk-free yield, right? Because it's government backed, but there's no upside. Your yield is your yield, and you're paying ordinary income tax on that margin or income that you're collecting on that. Whereas on the real estate side, without getting too technical and going into the weeds too much, there are tax laws and benefits such as bonus depreciation, which is going on a 5-year sunset right now. I think it's 80% this year that you can bonus depreciate anything that's on a 15-year schedule or shorter. So what that means is, even though your property may be generating income and you're getting distributions, if you're an investor or the owner, you're probably not paying taxes on that income in the early years because you have enough depreciation to offset that income. So there's a lot of, so your 5% or 7% that you're making on your investment is tax-free, or tax deferred, I should say. Nothing's ever tax-free. You're deferring the taxes, and eventually, unless you die, and then there's tax laws that kind of get taken into account there, but you're just deferring those tax payments through taking depreciation and other things. So that's one reason. So I think if you're able to achieve a yield at, or ideally above, what you can get risk-free, it makes sense because you're not paying taxes on that income in the early years. You also get the benefit of appreciation, whether that's organic appreciation, meaning just market growth, because you're in an area where rents are growing on a consistent basis. Like DFW, we have 140,000 people a year moving to the Metroplex. So nearly, 400 people a day. There's not enough housing, even with the amount of units that we're developing and have developed over the last 10 plus years, between 20 and 25,000 units a year on average. It's a lot of inventory, but there's a lot of people moving here. And so there's still a housing shortage, not only here, but all across the country. So if you have that rent growth, then you're going to have appreciation on the asset, assuming all else equal, right? If your expenses don't exceed your income growth. So you get that appreciation, you get the tax benefits, and you have a tangible asset. For me, early on in my career, I invested in stocks, and I still have a 401k and kind of do the diligent retirement things, which I joke with my financial advisor, who's been one of my best friends since I was 3 years old. Very boring investing. And I really don't know what I'm investing in. I mean, I understand profits to earnings ratio and things like that, but I really don't know what I'm looking for. So I rely on them to kind of make good investments for me, but I don't get the tax advantages when I invest in stocks and equities. And I don't normally get the appreciation. It's out of your control what the stock's going to do. So I invested in some Amazon stock a few years ago thinking, how could Amazon ever go down? Well, it did, right? So I don't think it's going out of business ever. But certainly there's just market influences that are outside of everyone's control that can impact the stock price and markets. And there's a lot of volatility everywhere right now, including in the real estate market. And there's a lot of different benchmarks that you'll hear people talk about that different lenders will go off of, right? You've got the federal prime rate, which Jerome Powell and his team have pushed. I've lost count, but I think it's been about a dozen times since last March in the last 15 months. And hopefully they're going to stop soon, because they push that rate up so high, more than doubled in the last year, that it's very hard for construction loans and kind of short-term bank loans to get done today at these higher interest rates. So it's really slowed things down on the transaction side of things. You've also got treasuries. So if you're going to put fixed rate debt on, a lot of times with Fannie Mae and Freddie Mac, which are multifamily lenders, they will go off the 5, 7, or 10-year treasury rate benchmark, and then they'll put a spread on top of that. So your treasury rate plus your investor spread is going to be your interest rate. So tracking those things, and there's been a lot of volatility in the 10-year treasury, right? If you're looking at 10-year fixed rate money, I was invested in a deal that we put 10-year fixed rate debt on early in 2022. And I want to say the 10-year was at about 175, and now it's up in the 370 range. So it's gone up almost 2% since the beginning of last year. Pretty significant, more than doubled on that benchmark. So,
yeah, very significant. Are there other benchmarks that you could elaborate on, or at least share at the moment, that we should be watching, or that you all are watching today, or that lenders are watching?
Yeah, so SOFR is another big one. So if you're talking about floating rate debt, and I should know the acronym, I think it's overnight fund rate, but it replaced LIBOR, which was kind of the floating rate benchmark that many of the banks and other lenders bridge loans would go off of before. So right now, I think it's a little bit above 5%. And so normally there'll be a spread on top of that, 300 basis points or 3%. So you'd be looking at an 8% rate kind of on the lower end for a bridge loan today, whereas SOFR a little over a year ago was kind of between 0 and 0.5%. So you would just be paying the spread or a 3 to 3.5% interest rate in early 2022 before the capital markets started to implode and just increase, which made the market slow down and values start to drop.
How do you feel about investing or buying multifamily properties today? I mean, in the current economic climate?
Yeah, so I kind of look at it two different ways, right? What I'm more as an investor, I'm focused on the cash flows because the market appreciation that we were seeing before it just wasn't sustainable, right? Debt was very cheap, not free. A lot of people would say, "Oh, it was free money." It wasn't free, but it was very cheap, right? If you're borrowing money at 3%, historically speaking, you go back 50 years, and I don't think there was a time period where money was less expensive. Now, that short-term debt's kind of up in the 7.5% to 8.5% range. It's getting expensive, but then you still have fixed Fannie and Freddie debt in the mid 5% range. So you've got a pretty big delta between short-term and long-term debt. But if you're able to buy something at a cap rate that's what I would call cash neutral, at least during the interest only period, that feels pretty good. And that's where we're seeing some deals trade. It might be slightly negative, meaning the cap rate's a little bit lower than what the interest rate you're borrowing at is. But if you're getting lower leverage, you're getting a lot of interest only. So for example, if you do a 10-year loan, it's pretty common right now at say 60 or 65 loan to value leverage, you're getting 5 years of interest only payments. So assuming you're able to go in and do some things to reduce some expenses or do a value add and increase rents or other income, then you can kind of get back into that positive leverage territory to where your cash flow exceeds your interest rate. I'm looking at that and I'm very focused on what my hold period is. And if I do have principal payments kick in, then there's an equation or a phrase called a loan constant that I don't hear a whole lot of people talk about, but that's really what your cost of capital is. So I want to make sure that my asset is ideally getting to a point where it's reaching that loan constant on a return on cost basis once the principal kicks in.
What do you see in terms of the next 6, 8, 10 months in multifamily specifically?
Yeah, there were a lot of debt funds, which is a bridge lender. And there were a lot of them that were just coming out of the woodwork after COVID hit. And there was a lot of money out there and that money wanted to be invested and put to work. And they were going into deals highly leveraged. So I would say second part of 2020, there were some agency loans still getting done, but really in 2021 and the early part of 2022, most of the deals that we were selling had debt funds being placed as the debt because they would go higher in the capital stack, meaning higher loan to value or loan to costs than Fannie Mae or Freddie Mac would go because they were being debt constrained. So a lot of groups would put this high leverage debt on. And if they bought a rate cap, meaning your interest rate could not exceed a certain level, then they're kind of sheltered and protected for that period of time. A lot of times those rate caps are for 2 or 3 years because these debt fund or short-term bridge loans were typically 3-year terms that are floating rate debt based off that benchmark and a spread on top, plus 2 1-year extension options. But given where the markets have shifted, they're probably not going to be eligible for those extension options. So they're going to have to do something by the end of year 3. And if they didn't buy rate caps, they might be paying 8% interest right now when originally they were penciling 3 or 4% interest. So their debt service has more than doubled in some cases. So I think we're going to see a lot of those deals come back to market because they're either going to have to do cash injections, raising more capital to get a new loan because they're this with where interest rates are today, they're not going to pencil to replace the loan balance in a lot of cases that they originally took out, or they're going to sell those assets or be forced to sell because they can't raise the capital. So we're going to see more of that because we're going to see a lot of those maturities from 2021 start coming due in the next 6 to 12 months.
Yeah. What do you think is going to be I was just thinking about investors are fearful right now, right? And I think it's obvious because there's like more money on the sidelines right now than ever.
Right,
Just like waiting. In your position, what do you see as like the way operators, because I know this is a big question I get all the time as well. We wonder it, everybody does, like positioning an opportunity to investors in a way that to really showcase, hey, this is a good time to buy something. Let's say, let's say over the next 6 months, if it's a good deal. I know you talked about, I loved your focus on cash flow type thinking, because we want cash flow. And how could you help maybe the operators, you work with many as well, to think through how they just communicate the story of the deal in a way that's like, no, this is a good time, or even communicating the story of the market, right? Or the economic cycle that, hey, this is a good time for investors to invest.
Yeah. So once again, it kind of, to me, it goes back down to those cash flows. So as long as you're not running the risk of getting into negative territory where you can't cover your debt service, and depending on what your goals are as far as IRR returns or just coupon mailbox money, it really all depends. And we've been seeing a flight to quality. So 80% of the people I talk to will say, I want something that's 1980s vintage or newer. Well, great, right? I understand there's less issues with plumbing, electrical, mechanical, electrical, plumbing kind of systems. But for that reason, there's also a lot of owners of that product that just aren't trading it right now. So we're seeing a lot of the older vintage deals trade hands. So to me, it kind of comes down to a few different things. Location is obviously very key, right? In my mind, I want to be in a market that is going to continue to grow because I'm going to have that rent growth and that organic appreciation over time, even if the next year or two might be a little bit tricky as far as figuring out what your exit value is going to be. I'm looking at the cash flows, and then I really want to understand who my operator is, right? Assuming I'm in a limited partner position. So who is my GP, my general partner, and who is their team? What's their track record? And then who's going to be managing the asset if they're not vertically integrated, right? Where they have management in-house. So I want to go meet those folks. When I go make an investment at this point in my career, I'm making pretty heavy investments. And I've been fortunate to meet a lot of operators and see a lot of people do really good things and make mistakes as well. So you want to learn from both, but I would say meet your general partner and their team, as well as the management team, and go visit a property, drive through, and if you can, tour the asset and understand how they're going to run it for you. Because I would say if you're looking at something short term right now, it's going to be a little bit tricky. But if you can kind of look at that 5-year horizon or more, real estate, just like everything, it goes through cycles, and the values are going to go up over time, right? If you're in the right location, you have the right operator.
Yeah. Yeah. No, many great points. And I know anybody listening right now is just wanting to know, how bad do you expect it to get? Or worse, or like over the next few months or a year? Just your thoughts on when we should see it come back.
Yeah. Yeah. I mean, it's very, in my mind, very market specific.
Sure.
There will be distress in my mind in every market because some people just got too highly leveraged and in over their skis. But other markets that have challenges on the coast, for example, insurance has been crazy. So we're seeing properties down in Houston and Louisiana and some parts of Florida where insurance has doubled or tripled, and the rents aren't growing at the same rate, right? So not only maybe has their interest rate gone up, but all their expenses are going up at the same time. And real estate taxes in Texas in particular, and other markets as well, can be very tricky because Texas is a non-disclosure state. So depending on the county in Texas, we've seen anywhere from 30 to 50% increases from last year on their proposed taxes. And then there's a process where normally an owner will hire their tax consultant to go in and protest those taxes and fight with the appraisal review board and see if they can come to an agreement. And if they don't, they go to litigation. And all of that takes time. So we're kind of in this gray period right now where they're still figuring out what the 2023 values are. So it's kind of tricky. But I think we'll see the second half of this year and probably the first half of next year, a lot of that debt fund money get flushed out. So we're going to see distress in a number of markets, like I said, because you can't refinance in most cases those same loan amounts, and certainly not at the same interest rates as they were going in. But as far as values, cap rates have expanded, I'd say 75 to 100 basis points from the low. We were seeing Class A deals trade in the mid threes, so call it a 3.5 cap in DFW at the peak. So early last year, late 2021. And now those same deals are probably trading at a 4.25, 4.5 cap. And then the Bs are going to be probably 50 basis points wide of that. So 475 to 5. And then the Cs are probably going to be 5.25 to 5.5 in DFW. So that 75 basis point increase has been about all else equal, right? Assuming your NOI has stayed relatively flat. Now we still have seen some rent growth, but also some expense growth, about a 15 to 20% drop on most values from where they peaked. And I really don't anticipate seeing it drop that much more because of where fixed rate debt has stabilized. Even though the treasuries are bouncing up and down, unless we get back above 4% on the 10-year treasury, which, like I said, we're in like the 3.7% range, but we've been down in the last 30 days as low as 3.4 and as high as 3.8. You're going to be able to get fixed rate debt in the mid fives. So staying in those kind of low to mid 5 cap range for Class C and maybe a little bit lower for B, to me, makes sense. And then looking at the treasuries, right? So if you're looking at a risk-free yield by just buying treasury bonds or buying real estate, I still see Class A deals being able to trade kind of in a 4.5 cap range, because that's going to be a little bit wider, and you also get the tax advantages than just buying a T-bill. So what I'm waiting to see is the institutions really start to reinvest, because they've been sitting on the sidelines for 9 to 12 months. Not many of them have made many purchases or trades, but we're starting to see Blackstone force some sales with some of their partners because they're getting a lot of redemption requests and having to return billions of dollars in the B REIT. But I'm curious to see when the other institutions have sat on the sidelines too much or too long and start to reinvest and the money start flowing back in.
How will you know that?
Tracking sales. And a lot of these are publicly traded REITs. So you're going to kind of see assuming you're subscribed to different publications. I read The Morning Brew, CRE Daily, Is Now, CoStar. A lot of these publications will announce major trades that have happened. And you'll notice the number of articles over the last year have shrunk quite a bit, where I can get through a quick scan over something in 30 seconds that might have taken me a minute or more before, just kind of looking at the titles of the different articles. So I think once you start seeing those articles expand a bit more and you read some bigger sales north of $100 million, whether that be single assets or portfolio trades, you're starting to see institutional money flood back into the market.
Yeah, that's helpful. I always love hearing where people are getting their information, right? I get that question often from listeners as well. It's like, man, there's so much you could try to read, right? Or digest. How do we know where to focus, right? Our energies to get the best information. So I just love hearing, where, man, some of the people like yourself in the business who are very deep in the business, right? This is your business, man. What are you reading and trusting? So that's very helpful. Doug, I want the listeners to know, I'm going to ask Doug our normal ending questions, but on tomorrow's show. But is there anything else, Doug, before we have to move to the next segment, that you would leave just a listener with right now who is, let's say, a passive investor or an operator that, man, they need to be thinking about over the next 6-12 months as they're all wondering that maybe I didn't think to ask you?
Yeah, I mean, the only things I would say is, and we're seeing a lot of people very focused on operations. So once again, just sitting down and going over budgets, and not to just do budgets to do budgets, right? But really come up with numbers and projections that you feel are achievable, and hold your team accountable to. If you're the operator, holding your asset managers and your management team accountable. If you're a limited partner, I guess just checking in with your general partner and making sure that they're doing those things, and that you're getting those consistent updates, that they're focused on operations and not just the next deal. There's a lot of groups out there that I think got carried away and bought a lot of stuff. And I'm not going to name names. A lot of folks, or a few people in particular, have hit the headlines in the last month or two because some assets have been lost. But I think there was a lack of focus on operations. Everybody just got too carried away with buying.
Yeah. No, the market at that time covered up a lot of mistakes, right?
Sure.
And that's, I think, why you're going to see everybody focus more on operations right now than they ever have. And so no doubt about it. And we should be. We want to operate as efficiently as possible, right? And not count on the market correcting those things.
Yeah.
Right? So Doug, grateful again for your time and to have you on the show today. And no doubt, I mean, you're a prime guest. Just your expertise in the field is what we need on the show more and more. So grateful for your time. We're going to talk more tomorrow. I want the listeners to know that. And we're going to dive into something you need to know about when, I don't care what asset class you're in, or even if you're a passive investor, it's going to give you great information to talk to your operator about, or if you're an operator, you're going to be better prepared because of tomorrow's episode with Doug. Doug, tell the listeners, though, how they can get in touch with you and learn more about you.
Yeah, so LinkedIn is an easy way. I always joke, Doug Banerjee. I'm the only Doug Banerjee in the world. So I'm pretty easy to find. So connect with me on LinkedIn. My email is D for Doug and last name Banerjee @greysteel.com, GREYSTEEL.com. So email works, or LinkedIn.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.